Yes. Well, not yet, because technically we're supposed to go through and do this a certain way. There's always instructions for how to do these.
Yeah, we'll follow the instructions and we can go about it.
Can someone offer a prayer?
I can do it.
Thanks, Brent.
Our Father in heaven, we're grateful for this day. We're grateful that we can meet together and learn more about this case that we've reviewed and studied. And I ask that will please help us to learn more about it, and please bless that we can prepare ourselves. And we're grateful for all that was done. We ask for thy Spirit to be with us, and we say these things in the name of Jesus Christ. Amen.
Amen. All right, thanks, Brent. Okay, so next we are supposed to read aloud as the group follows along. All right, so I'll read these points out, and everyone's supposed to follow along. It says, so far in this course, we have seen a few common threads and takeaways. Founders matter, experience, passion, and vision shapes the business and can make the difference between success and failure. Business plan at the founding stage of the company is a collection of hypotheses. In other words, guesses. Startups create value by systematically testing hypotheses and making changes to the plan when the test results indicate a need to change. Early tests tell us a lot about the viability of a business and where more information is needed. Previous cases analyzed business models the founders had already chosen. Now we get to see at the moment of choice. Can you guys give me 1 second?
Yep.
Sorry, my wife needs something real quick. Sorry.
No problem.
I need this.
Hi, Susan.
So, well, I'll go back to this this other model. The first page of the spreadsheet, I just answered the number 1 and 2 fine, but the number 3, qualitatively, how we're supposed to go back to Dropbox, Dr. John's, and Rent the Runway and compare in terms of EBIT margin.
Mm-hmm.
How did you have an answer for that one?
I came up with something, but I don't know that it was right. I did my best to remember I went back to the cases and found just some of their initial starting costs.
Their needs for their greatest need for capital.
Yeah, I wasn't sure on that. I just kind of took what I honestly have no idea, Susan.
Okay, sorry about that.
Huh.
You're good.
So to compare them, we just kind of go back and look at the numbers.
I think, yeah. All right, should we get back to question 4?
Yeah, give me 1 second. I gotta hook my headphones up to my computer.
Okay.
Okay. There we go. All right, can you guys hear me?
Yep.
So I know we're long, but it was the worst case study I've ever read. The typos and the errors made it very difficult to read.
Okay. Sorry, my headphones just gonna connect. Okay. All right, let's get back to the thing then. Okay, so we're supposed to take a vote. And so I will mark this at 4:21. Okay, so which business model option do you favor?
I favor data analytics.
Okay, so you favor data analytics, you said?
Yep.
Okay, and Susan?
I favor razor and razor blades.
Okay.
I actually want a hybrid, but that's not one of the votes.
Yeah.
Yeah.
And I I kind of favored a hybrid also. In all reality, I would favor data analytics, but the traditional strategy I thought broke even the quickest. So I'll show you guys my model and kind of why I thought that. But I kind of chose Razor and Razor Blades with the hybrid of data analytics, but we can't choose that. Okay. So I guess I can say I voted traditional strategy.
So okay. you voted traditional strategy?
Yes.
Okay.
All right. So give each person who voted a chance to share why he or she voted the way they did. If a choice is left without someone voting for it, discuss as a group the pros and cons of that choice as well. Specifically for each alternative, discuss a number of the following. All right. So who would like to go first and tell why they picked their choice, and then give answers to a number of potential customers, which customers would be expected to pay the product, who the competitor are. Do you guys have this page up?
I have it up, but I don't know that I have the answers for those questions.
Well, give the best answer that you can off the top of your head.
So do you want me to go? I'll go first, Brent, if that's all right. So I just say the number of potential customers for Razor and Razor Blades was, yeah. I just said it was a lot higher than the traditional or the data. Well, the data, if you're giving something for free, you would have a lot more customers. So, but I think that it's, there's, for the cost, it was so much lower than the traditional cost of $40,000 for the machine. To only have to pay $6,000 for the machine would then have given them a lot more customers to balance out the revenue. And who are the competitors and their likely response? I don't know that they have that many competitors, because so there's 50,000 biolabs and only 3,000 of them had machines. So the sequencer machines, I think, are going to be really popular and make them available at a better price. I don't know who's echoing, but
oh, it might be me.
If they will offer it for $6,000, they're going to get a lot more of the market share. So they'll have a lot more people, a lot more customers in that direction. So the founders' goals were, I even wrote down what their goals were to have it in every household, which I can't imagine every household needs a DNA sequencer, but I think that if they offer it to the public for that reasonable price, then they'll have a lot more. And that's the investors' goals are just going to be to make money. So.
Perfect. Brent?
Okay. So I chose data analytics because I feel like it's the best long-term company. I feel like with the traditional strategy, they're going to do really well, really fast. Like you said, that's where they're going to break even the quickest with that method. But I feel like the competition is going to come up with a similar product within a matter of years, and then they're still going to compete. I don't think there's not going to be a demand for these machines, but I don't feel like in the end it will be the most profitable. I really like the hybrid the best between Razor and Razor Blades and data analytics, because they would break even much faster, and I was just looking at those free cash flow curves a lot in making my decisions, and I feel like they would break even faster and be able to have exponential growth. The number of potential customers with data unknown and maybe a little bit unlimited, because so many people could benefit from the data provided by the machines if they sold little pieces of data. The customers that would be expected to pay for the product would be the people who are paying for the data. The competitors, I didn't see a lot of competitors, because I mean, there is a little bit of data. It said 90% of the machines are being used for data analysis. So there would be some competitors, but I feel like this company would have so much data compared to other people that there wouldn't be a lot of competition. The founder's goals, I remember reading in the case that his goal was to better medicine and to decrease the number of misdiagnoses that there were.
Mm-hmm.
So I feel like that's part of his goals. And the investors' goals, I'm not sure on those, I guess, to get the most out of their investment. I don't know who the investors are, who they're going to be, but if they do invest in data analytics, they're going to have to be very patient with their investment.
Yeah.
Because they're not going to get a return very fast.
Yeah. So the reason I picked traditional strategy, well, was partially because you guys picked the other two. And we had to talk about it anyways, but also because it returned to broke even the quickest out of all the cash flows. The number of potential customers goes way down when we talk about the traditional strategy, but the profit margin goes way up. So instead of like, a 20% profit margin, we're having like a 95% profit margin. Obviously, it was hard for them because they would have to compete with people like Illumina and Life Technologies, who are also in this market. And there was some risk with that, but it was kind of more secure gain for them. It was probably more likely that they were going to make money and do it the traditional way. Maybe they wouldn't be the market share leader, but they would still make money. So I think the people that were really targeting with this were just big research companies, universities, maybe large hospitals because of the price. Not everybody could buy it. So obviously their competitors, their two biggest market share owners were Illumina and Life Technologies. And he talked about in there how if they were to do that and, put it at $40,000 or whatever, that Illumina and Life Technologies would just drop their price for a certain amount of time until they put Genapsys under not making enough money, and then they would just raise their prices again. So they're worried about the competition from Genapsys or from Illumina and Life Technologies. So I kind of agree with Brent. The founder's goals were really just to kind of better medicine. I think that's really what he wanted to do in the long run. I don't know. He talked about how for him it wasn't even about money. Just as long as he could better medicine. And the investors' goals, just to kind of make money. And I guess that's kind of why I chose the traditional strategy, because that was the quickest way for investors to make any money. Maybe they wouldn't make as much, but they would still make some. Okay, so the next question says, using a poll tool that allows, which we're not going to use because it won't download, go through the following questions. Using the Excel model you created before class, answer the following questions individually and then compare answers as a group. So I guess look at those and answer the question. So go to your sheets, I guess, and enter and increase your EBIT divided by sales and hold everything else equal and see what it does.
So, okay, Brent, you answered my question, what EBIT was.
Yeah.
And they never said that anywhere. They didn't explain what that was. And the same thing with CAPEX. I have no idea what that is.
That's capital expenditure. And you should have learned, if you took managerial accounting, you should have learned what EBIT was.
Capital.
But it's still hard. But I just Googled it,
I just Googled it too.
I didn't know what CapEx was.
What is it?
I didn't know what that was either.
What?
Capital expenditures.
Okay. So go to our Google sheet and increase the EBIT for.
Yeah, and see what happens to. I think you can just go on the first sheet where it has the 3 sections and you can increase one of the percentages. Like I did mine from just 5 to 10.
I did mine from 5 to 50.
Yeah.
Just to see the major difference.
And so, okay, tell me, what did you look at then when you changed this amount? Did you look at year 1? I compared year 10, and wrote all of that down on each of those different scenarios that they gave us. So what did you compare? The FCF?
Yeah, well, just those charts under there. It shows you that, it shows you time to payback by, you start at 0, and then if it goes up, pretty much just if it goes up faster, if it goes up slower. That's pretty much the simple analysis of it.
So if we increase EBIT, it increases the free cash flow and it decreases the, well, I don't know if it decreases, but it increases more quickly, and you don't have to worry about breaking even taking so long to break even.
Yeah, and the reason for that is because your earnings before interest and taxes is, it's what profit did your company make. So if you increase the profit that your company made before you took out interest and taxes, then obviously your cash flow is going to go up quicker, So if I only made 5% of my total revenue and profit, then, that's not very much cash flow. But if I made 50%, then I made 50% of all my revenue stayed in as profit, and then I had to take out interest and taxes. But, so I agree with Brent. It increases.
That's all we need to look at, right, on that one?
Yes.
Are we supposed to record these anywhere? Not really, right?
What do you say?
We're not supposed to record that anywhere, or just...
Well, it's a vote, so I put it down as a vote. And I voted it increases. Susan, what was your vote? What did you see it do?
Yeah, increased dramatically.
Okay. All right, so once everyone has responded to the question without help from anyone else, compare answers, discuss until the group has it set on. We all agreed on increase. So did this picture show up on your guys' page?
No.
Didn't on mine either.
Which picture?
Well, there's not a picture, it's just a blank box. But it's supposed to be a picture. I don't think it showed up on anybody's page. Maybe nobody's using.
We can discuss highest burn rate, though. It would just be a steep down.
You're cutting out, Brent.
I'm assuming that the highest burn rate, if we were going to discuss that, it would just be a steep curve going down, correct?
Yeah, that's what I would take as burn rate. So just, whatever, however we spend the most money.
Okay, so tell me what the burn rate is, because I know it said that this will have a burn rate of $700,000 a month.
That's how much money you're spending a month.
How much
the
money?
burn rate is basically what you're spending to make your company work.
Like how fast you're burning through your cash.
And the burn rate is probably higher as you start your company, as you buy products or if you buy machines, right?
Are you guys looking at this on Mozilla, or are you on Google Chrome, or?
I just made it on a spread Works document.
Okay, well, let me look, see if that picture will come up on Google Chrome, or not on Chrome, on Mozilla, because everything works better with Mozilla or iLearn.
So,
because you can't really answer the question without that.
Did we skip over if NOA sales increases, cash flow?
No, we just talked about, well, we haven't gotten to that yet.
Okay, I have them out of sequence then because I have that second. And so we're talking about burn
rate. We did. Yes, we did skip that actually.
Oh, okay.
But my answer is just going to decrease.
It did make a big difference to increase those different.
It doesn't show up on Safari either.
Okay, hold on. So third vote, I say that it's going to decrease.
For the burn rate?
No, sorry. We did skip that, what you were talking about. That was my fault. So if you raise NOA divided by sales, it's going to decrease the cash flow. because you're having more.
You have more, basically, yeah. You have more costs associated with maintenance or buying machines or something like that, right?
Your capital intensity goes up. Okay.
Yeah, I also agree that it decreases.
Susan, what do you think?
For the NOA?
Yes.
Yeah, it went down a lot too. I did do that on the just testing out the different percentages like they suggested to do.
Okay. Okay, let's see that picture. No, it still doesn't show up. So we can't really do this question because there's no picture.
Okay, well, so I'm still on the burn rate. On the curve below, which segment represents the highest burn rate?
Yeah, but there's no curve below.
Oh, okay.
So that's why I'm saying we have to skip the question.
So let's think about this for just a second though. Which segment would have the highest burn rate? Which one is going to spend the most money?
But we can't do that because the answers are A to B and we can't see the curves.
I'm just trying to think about how each one of those companies, each segment would be spending money.
Well, the one that's going to spend the most money is the data analytics. We can see that from our, they're going to go down to roughly, they're going to be $67 million in the hole at 2019.
I know, Kim, that's why I just went, that didn't make sense to me.
It doesn't mean it's bad because look, it also goes up the highest if you change numbers a little bit. So it's the biggest investment. So that one has the biggest burn rate. The traditional strategy has the lowest. Anyways. All right, since we couldn't see that, it says once everyone has responded to the question without help from anyone else, compare answers. So we're kind of did that already. What strategy have we seen that flatten or lengthen the cash flow curve? So we obviously saw that if we have to increase our NOA, then our curve's going to flatten out or it's going to get longer till we can pay back. So. We draw the flow curves for Dr. John's product, Rent the Runway, and Dropbox as they were described in the cases. Just make a rough guess as to the shape of each of these cash flows. So I thought with like Dr. John's products, they were really successful. So they might, their revenue was quite high, but it was very capital intensive. They had to, have a production facility and a sales team and blah, blah, blah. Dropbox kind of was too. They were always kind of in the red, I guess you could say, when it came to cash, because they didn't really have any revenue. They didn't really have a way to
until they started.
Revenue. Yeah.
Until they started keeping
2% of all their customers. So, and then Rent the Runway. I thought Rent the Runway was probably the best because they had a lot of success and they could easily pay off their assets right away.
Yeah, it was quick
turnaround. So, I think Dropbox would probably look most like the curve for the data analytics, and Rent the Runway probably most like Razor one maybe, and
traditional,
and Dr. John's like Razors. Yeah,
that's what I was thinking.
All right, so B, then it says, describe to each other what happened to Dr. John's if they had decided to build an independent company rather than get acquired. What activities would John have to do differently? What impact on the cash flow curve would these activities have? Flatten or steepen, shallow or deepen, increase or decrease time to pay back? What do you guys think?
Well, my opinion is that it would go down if he decided to be an independent company. I feel like his curve was going up, and it would go up a lot if he decided to merge with a company. If he didn't, he would have other difficulties because he would eventually, it would probably eventually flatten out because of other competitors. I don't know.
Yeah, I kind of agree with that. I think obviously if he would have done his own thing, he would have had to build a plant and he would have had to invest in quite a few assets and a lot of capital. So he would have had to buy a lot of things, warehouses, plants, all these different things to be able to up his production to match demand for his product. So that obviously would have taken a lot of cash, and for whatever cash he gets from investors, from bank, he obviously has to pay it back, at an increased interest rate. So I think it would have deepened. It would have dropped below the line quite quickly. And in time, it would have increased, but it would have decreased his time to pay it back for sure. What do you think, Susan?
I don't know, because so the decisions he makes in Dropbox that favorably impacted the cash flow curve was.
Oh, we're up on Dr. John's on B.
On B. Oh my goodness. So I don't know how I'm. Yeah, my formatting changes, so I don't know where you're at. I guess because I thought we were on Dropbox.
No, we're on next. Describe what happened to Dr. John's if they had decided to build an independent company rather than get acquired.
Well, I would say exactly what you did, that he probably would have just had to keep sinking more money into it and kind of go backwards.
Yeah. Okay, so then it says, discuss the same for Rent the Runway. If the founders of RTR had been able to convince the dress designers to retain ownership of the dresses, what impact would that have had on RTR's cash flow? What do you guys think?
They would have been a lot more dependent on other people rather than their own company.
Yeah.
So I think that the way that they did it was much better.
Okay. Brent?
Okay, my thoughts on this are they wouldn't have had to, I guess they wouldn't have gone negative as much, if that makes sense. So their curve wouldn't drop below because they wouldn't have had to pay for all of the dresses.
Yeah.
Paying for all those dresses in the beginning was expensive, and they were making enough that they would pay them off quickly anyway. But if they didn't have to do that, they would have had a steep cash flow increase, I guess.
Yeah, I agree totally, because then they don't have to pay for the dresses. They don't have assets other than like a warehouse.
Yeah, and just
so they would have just been able to pay overhead costs like a warehouse, lighting, salaries, but then they would have made just pure profit off the dresses. Mm-hmm. They probably would have had to split some with the designers, but yeah, I think it would have made their cash flow payback time severely decrease, and it would have steepened it also.
Mm-hmm.
Okay, what decisions did Drew Houston make in Dropbox that favorably impacted the cash flow curve? I thought probably one of his best ways that he increased the cash flow curve was to grow organically. Stop paying for advertising or trying to partner, but once he went to organic, kind of people joining because their friends joined, he got rid of an expense. He got rid of advertising expenses, and also he was able to kind of have a viral factor there. And so he was able to get more customers, which meant in the end more revenue without having to pay a lot of money to do it.
Mm-hmm. Something I remember from that case is that he changed his prices.
Yeah.
His pricing as well. He was frozen.
Yeah, and he ran very lean.
Yeah.
That was another big thing. He didn't have it wasn't really capital intensive.
Mm-hmm.
Well, because it's intellectual property instead, they don't have that overhead as much, right?
Well, the overhead they don't have to pay off assets
Right.
as much. They just have overhead is like the rent. You know, they had to pay rent for a building and pay for computers and salaries, but they didn't have to pay like to actually pay off a actual asset like dresses or a factory.
Right.
So yeah. All right, now let's look at the choices Genapsys has from a cash flow standpoint. For each business model option under consideration, compare the following. Net present value. If some of the options have similar NPVs, which is riskier, it is advisable to take additional risk. Is it advisable to take additional risk for a similar NPV? What do you guys think? So, and on your sheets that you're looking at, I kind of changed some of mine, but make sure they're at the original values. That way we can look. Just kind of what I thought. Razor at the original values, Razor and Razor Blade strategy and traditional strategy had about the same net present value. But Razor and Razor Blades, as we see from on the Genapsys model, has just a little bit of higher discount rate, which means it has a little more risk involved. So I think if I was going to have the two, and they didn't really differ much, I'd probably go with the traditional strategy because it's a quicker time to pay back, and I'm not really making a lot more cash than I would have using Razor and Razor Blade strategy. Obviously, the highest net present value is the data analytics, but it doesn't really doesn't even break even till 2023, just barely starts to break even, maybe 2022. So, you know, that's rough for investors, especially to hang on for 10 years before you're even in deposit cash flows. But it did have the highest net present value, saying that in the future it was going to produce the most cash, and it also was increasing very steeply compared to the others. So that's what I would say.
Well, it's a little bit over my head, I have to say.
What do you understand of net present value, Andrew? Because I've never heard that term before.
Oh yeah, so it's actually a function on Excel, and it's called the MPV function. So basically what net present value is, it takes all your cash flows. So say that you operated for 10 years and then you took like a $20 million loan, right? I think, what was the financing that they were supposed to have for this? It was like 10, 20, right? Yeah. So it's going to take the $20 million that it cost you, and it's going to take all your cash flows and add them up over the 10 years, and then subtract. It's kind of hard to say. And then, well, it's also going to take all your cash flows and account for your discount rate, which was 12, 15, 20%. And then it's going to take all your cash flows added together through the 10 years and minus it by your loan, and that's how much net present value is.
Right.
Okay.
They take off the initial investment and the depreciation, and all of that's calculated into the same amount.
So it's pretty much how much money after you paid off everything you'll be left with at the end.
Okay.
Yeah. So, yeah, that's that. All right. So do you guys think it's advisable to take more risk, like in the sense of like the data strategy where they have a higher NPV, but there's a lot more risk involved?
Right. That's a hard question because I'm not a risk taker. It depends on how brave you are.
Yeah.
Yeah.
I also think it depends on how much passion you have for it, how much you really, I don't know. I think it would depend on the product, depend on the industry, depend on the market. Yeah.
Okay.
Because taking that big of a risk, most of the time, probably not, because that's a long time. That's like
and it's hard to look at oh well, it's only 15,000 more than the other strategies, you know. So is it worth the risk to really go with the data analytics strategy?
I don't know. Beginning.
Yeah.
They weren't going to make that much more, so I think you have to determine that individual cases too.
Mm-hmm. Okay, how will Genapsys raise funds to support each option? Is there any option clearly more attractive to investors? Support your answer in your discussion.
We've kind of already
Well, also a little bit. I believe the traditional model is the most attractive for investors.
Yeah, I think so too.
Quick, break even quick, and then if they want, they can pull out.
Yeah. Yeah, they're gonna get their money back right away.
Mm-hmm.
I think that too. I think that's probably, and also has the lowest discount rate, which means that it's probably the safest one to go. And so it's still a high return of 12% to the investors, but it's pretty safe for them that they're going to get their money back because there's such high profit margins. They only have to sell a couple machines to make money. What do you think, Susan?
Yep.
I agree with you there.
Okay.
I'm trying to write everything, not everything, but I'm trying to take notes as we go so that I can keep track of everything as much as I can.
Okay. All right. So the next one is, for each option, how much of the company will the founders have to give up to reach the goal? And I think this was kind of your question here, Brent, that you asked. So when investors invest, they don't just give money, they also are taking part of the company because they own part of the money that the company has. So depending on how much money they give is going to, so when it says something like on question 1, it says, assume that you have found an investor willing to invest at a $20 million valuation. So that's saying that your company is worth $20 million.
Yeah.
That's how I took it, right? So any extra capital that you had to raise to go to do one of these strategies is going to raise, it's hard to explain. So how much capital would you need to raise for each strategy, right? So this is how I kind of looked at it, and I don't know if this is right. So this is just my best opinion. So I saw okay, so how low is this cash going to get? So I can see the cash flow here. Okay, on the traditional, with the basic assumptions, this is going to reach about 10,000 in the hole, or 10 million in the hole. So I need to have, give or take, and I put 12 million because, you want to have a little bit extra money in case it goes deeper in the hole. All right, then I looked at razor blades or razor and razor blade strategy, and it was going to go down to 11 million. So I put 14 million, add a little bit extra money on it. And then I saw the data strategy is going to go down to 67 million, and I put it at, or 68 million almost, and I put it at 70 million. That's the extra funds that they would have to raise, which is a ton. So then when you drop down to B, you got to take the 20 million of the original valuation, plus it by how much more money you need. So if I had 20 million and then I needed 70, well, I guess you wouldn't need 70 more million. Well,
so for the traditional, you wouldn't need any more. You'd have an excess of 10 million, right? Or 8 million.
Well, that's what I'm kind of confused with this.
That's where I was confused too, because
given the 20 million,
the first two strategies, you wouldn't even need 20 million.
Given the 20 million pre-money valuation and your answers to 2A for each strategy, what fraction of the business will the founders continue to own? Example, if the company has a 20 million valuation, raises an additional 10 million, the valuation increases to 30 million, and the founders will own 20, but divided by the alternative, the company raises 30 million. Yeah, that's kind of confusing when you bring up that point. I was taking it as 20 million was the base, and then we had to raise additional money on top of that.
Because in the first one, if we needed, like you said, 12 million, you'd have, if you received funding of 20 million, you'd have 8 million excess. What do you do with that? How to own more than they needed to invest anyway,
Mm-hmm.
It makes sense what you said for the data analysis strategy, adding 50 million onto that 20 million.
So and that's what, there's no video. I think, and that's kind of where the videos come in, because it doesn't explain this to anybody.
Yeah.
I mean, it kind of does, but not really.
I don't think that we can really be docked or penalized because there were no instructions, and we're doing our best to understand it. I don't know. I'm confused on it still, but
So I think I'm going to
I
leave
like-
mine personally. I'm
I
going
like
to
the
keep the 20 million, and I'm going to put like an extra 12 million, extra 14 million, extra 50 million.
okay.
That's how I'm going to look at it, I guess.
Well, the question is, how much of the company will the founders have to give up to reach the goal?
Yeah, that's the second question.
And so,
So
they're just,
then you got to take 20 million divided by 20 million plus additional, and that's going to give you a percentage. So I had like traditional strategy, 63% of the company, Raise and Razor Blade strategy, 59%, data analytics, 29%.
How did you do that exactly?
What did you say?
How did you do part B exactly? I really do that one.
So if you take your 20, so you always, your front number is always going to be the $20 million valuation. And let's say for the
Okay.
traditional strategy, I need to raise another $12 million. So I'm going to take the 20 million and I'm going to divide it by the 20 million again, plus the additional capital I had to raise. So like in the case of the traditional strategy, if I had to raise an additional $12 million in capital, then I would take 20 million divided by 12 million plus 20 million, and that would give me 63%.
Oh, that makes sense.
So then you
And
go
then-
through and you do that for all of them.
Okay. Gotcha.
And so like with the data analytics, if they had to raise an extra $50 million or whatever, then they would only own 29% of the company. And that's kind of why I shied away from that, because you don't want to give up most of your company. You know what I mean?
That's true, yeah. Okay.
So, but I don't know. I mean, that's,
so this is, we're working on the worksheet, but this is one of the questions on the Excel sheet under the financing implications. I mean, talking about the same thing, but I don't have, should we finish the questions first and then go to the worksheet?
the question, this is the question.
Okay. Oh my gosh, I'm a little bit lost. And so, because that's the question, assume that you have found an investor willing to invest at a 20 million valuation.
Mhm.
How much capital would you need to raise for each strategy? And so, yeah, I have no idea how to do this. So,
Yeah, that's what we were just talking about, how to do it.
okay. So we're going to take the 20 million and we're going to divide that into what? I don't
Into
have
the
any
original
idea.
20 million plus the additional capital that you raised.
And which we're speculating on.
Yes, it's all speculation.
Yeah.
Let me share my screen. Probably the easiest way.
I understood that, Andrew. Thank you.
You're welcome. Gosh, I hate screen sharing here. Okay.
The problem is I already had three boxes up, and so it's just crazy. This is crazy to me.
Can you guys see my page?
Yeah.
Well, when you're not talking,
Or when you are talking,
or when
actually.
you are talking.
Okay, so let me say this. Look up in my formula bar. And that's what I use to get it.
Okay,
Yeah.
I want it to stay up there. Okay, so let me just write that down. 20,000, and it's E32 plus 20,000. Yeah, how are we supposed to do that? I think that's so retarded. 59 and 22%.
But obviously don't just take my answers, figure it out, on your own, I guess, because that's technically what we're supposed to do. This is just my best opinion. I really honestly don't know.
That makes more sense than what I was trying to do.
But you raised a good point that if the investor is willing to invest 20 million and we only need 12 million, then why do we need to invest, raise more capital? I'm actually considering
Yeah, my
into
original numbers for 8 were like I'd have positive 10,000.
Yeah, I think you would just put 0 though.
Okay.
I think because if you need to raise 0 or more capital, that's probably what I'm going to go back and do. Because when you divide it into 20, again, you're saying that this is the capital that I already have. So really the only one that we'd have to give up anything on would be the data analytics strategy, I feel like.
And that would still be okay. Yeah, that makes sense.
I don't know.
That means you'd own 100% of the company.
Yeah, with those two.
And Razor Blade, right?
Yeah, well, I mean, you would have to go to some, wouldn't you? Because someone's still giving you 20 million.
Or I guess you'd. Yeah, let me change that.
I don't know. That's so confusing. Given the $20 million pre-money valuation, what the frick does pre-money mean? All right, sorry. Let me stop my screen share. Okay.
I think you're good. Yeah. So it's like I feel like.
So wouldn't you divide the 20 million by the net present value to come up with the different figures?
No, the net present value doesn't have to do anything with
or the initial investments. I just, none of it's clear.
What don't you understand, Susan?
I'm completely lost. I have no idea how to do that calculation. And you said, just come up with what we think they might need to invest and do that. It just doesn't. I'm never going to be an accounting major. So.
Well, this isn't accounting, technically. Accountants want to deal with this.
Assume that you have found an investor willing to invest at 20 million valuation. How much capital would you need to raise for each strategy? So what numbers do I take? So for a traditional strategy, I've got $20 million. I don't know how to do any calculations to come up with a figure.
Well, I don't think you need to do any calculations. The way I did it is I just took, how much are we going to drop down below 0? So how much cash are we going to need when we're not producing any cash? So like with the first strategy, it was 10 million. The second strategy, we drop all the way down to 11 million. With the last strategy, we drop all the way down to 67 million. So you don't have money to cover those costs. So that's why you need an investor. Once you break even and you're in the positive cash flow, then you don't need investors anymore.
So the difference, we would take the 20,000, whatever it is, 20 million off of the 67 million and say we needed 47 million.
Mm-hmm.
Yes.
Yep.
That's how much additional we would need after that investor invested 20 million.
So that does give me figures to calculate to estimate a number for that.
Mm-hmm.
Okay. So I can do that.
Okay, guys, I've got to run. I've got to go to my class.
You're fine.
Well,
Thanks for your help, though.
All right, we'll see you, Brent.